Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. Claude is back from being MIA last week. How you doing, Claude?
Great to be here.
And we've got Andrew in the house. It's also the last day of 4C season, so all the best 4C, all the best companies report their quarterly cash flows today, right?
When you've got great news, you always leave it to the absolute last minute.
A deluge of drudgy stuff.
It's funny, I was just looking through them this morning, and it's just my constant thing is just like, that's still around. Like, that's my general. Let's get into some good news. So I'll roll through a few. Cameroon starts world first malaria mass vaccine rollout. A breakthrough Alzheimer's blood test to detect 15 years before symptoms urge. So there's a new blood test to detect Alzheimer's super early.
Saving people from malaria, that's pure. I really hate mosquitoes. Few animals in the animal kingdom that I actually hate.
Yeah, no. I was kind of keen to get rid of them. I think I've talked about this on the pod before. You guys are like, there'll be some horrible consequence. I'm like, it'll be fine. All right. Should we jump into some horrible macro news?
What's going on?
Well, Andrew, you were mentioning the Evergrande. There's a US base attack. There's a few things going on out there.
Yeah, I always find it interesting because it's more reflective of the bubble I live in or something, but you sort of see some news come out and you go, oh, wow, that's a big deal. And then you sort of go looking for the write-ups from various publications. And it's just like, it'd be on like the equivalent of page 20 or something. But there's some retrospective on Tony Abbott. It's sort of like, it feels like the priorities are a little bit out. I mean, Evergrande, for those that, have been living under a rock, huge Chinese property developer, they got in trouble way back. I think it first started showing cracks in 2019. Anyway, they finally...
it's even 2015, I think. I remember that being part of the bear case in 2015. I think it's been a really long time. But yeah, 2019 was when it was like really teetering, I think.
And I think that was the first failure of their bond payments or something.
Yeah.
Anyway, so it's finally being put into liquidation. It's going to be wound up. So it'll be interesting to see what, if any, contagion is from that. I mean, it's always rolls off the tongue. It's just like, they're going into liquidation, or they will be defaulting on a bunch of money that they owe other people, and presumably those other people / institutions, companies, etc., will be unhappy about that. It will represent a loss. We've also got Country Garden and various others. I mean, Evergrande is the biggest, but there's others, and they're also in a little bit of trouble. I think the interesting thing was that more than a few people thought that China might just come in and save them, but they haven't. So is this? I don't know. Maybe this is hyperbolic, but is this the Lehman Brothers moment where the powers that be have said, no, we're going to let you go. We're going to let you fail as a warning and signal to others. There's not a blank check here. But on the other side is like, well, can you do that for everything? What else is sort of lurking under the surface there? So a couple of quick takes, and then I'm really keen to hear what you guys think. One, it reminds me of how slow these train wrecks can be. As you said, Matt, 2015, we're knocking on the door of 9 years since worries first happened, 5 years since like it became really kind of apparent, and it's only now. It's only now that things are happening, which is a really good, I think, reminder that you can see issues brewing and it can feel like forever before they actually become apparent. And I think that also happens on the positive side of things as well, where you see, an interesting business, you feel as though it's got potential, good sales momentum, a pivot past break even, all these things, and just think, why isn't anything happening here? And it can sometimes take years, and then it's I guess it's a gradually then suddenly kind of moment. So that's the first take. And the other take is I don't know if it feels like the world is very much in a it's okay, everything's going to be cool now. I saw the IMF come out this morning sort of say, actually, no, we only think it's going to be a soft landing, which is probably the most bearish signal that you get. The IMF is now saying that. But it feels as though am I jumping at shadows here? Is this like a non-event, or what do you think?
Which you mean Evergrande?
Evergrande, sorry. Yeah.
Yeah, I mean, it's tricky to say with China because it's been like teetering on the edge for so long. It's kind of how I think, like all of the Chinese property market. I guess my thinking is we shouldn't assume a financial crisis. Like just the structure in China is different. I do think it points to stagnation in China, and that's a much bigger, more persistent problem that could shape the next many, many years. So that's kind of my thought on it. I just don't, it's much less likely the way China's structured for there to be like a Lehman moment. Basically, they push all the debt out to local government and use that as a way to control them. And then the central government stays completely debt-free. So if you look at like well, not debt-free, but very low debt of the central government, the idea is they could always be the backstop. And that's kind of what keeps the whole system going. So the way the Chinese system would break, I think, is if there was some belief that the central government couldn't backstop everything. That would be the problem.
Interesting. And what about your thoughts on the impact here in Australia? It's our biggest export partner. They have used a huge amount of iron ore and raw materials to build a lot of these cities. You saw some of the ghost cities firsthand, Matt, like 10 plus years ago. I mean, is there a point at which this incredible, what seems, at least from a distance, oversupply combined with these financial fractures has a impact on demand? And I'm going to make this up, but I feel as like it's some very significant proportion of our iron ore exports are in China, like 40-something%, something, I don't know. It's massive, right? Is that, again, am I looking for a reason to be bearish here or?
No, I think it's a very real concern. I'm surprised. At first, I thought that would have happened earlier because Chinese construction is already down. But what you're seeing at the moment is like Chinese property prices are down, but there's still this backlog of existing stuff that's being built. It's not increasing, but it's just like it takes a long time to build all the apartments that have already been paid for. And so that's seen demand continue for longer than I had. Like if you just look at prices, they've already come off quite a bit. And new builds are stopped. Like people aren't planning to build new stuff, but there's just this backlog. So yeah, that'll mean there's demand for a while yet, but it could be like 6 months, 18 months, 24 months before you start really seeing it. And the question is just, does anything else fill in the gap? And it could be a big gap because it's like 30% of China's steel, I think, is in some way property related. Property infrastructure is, anyway, I don't have the numbers.
But there's the overbuild on infrastructure too from what I understand.
Like magnetic levitation trains everywhere. There's definitely a lot of overbuild in a lot of different dimensions. So and they're like 50% of world steel demand. So that's huge, right? That's actually what makes me most bearish on like a lot of the commodity stuff, including copper and other things. It's just that are we actually just seeing how much everyone just assumes that like decarbonization will be incremental to all the demand, and it will be, but it could be offset very easily just by a 20% fall in China, for instance, in demand. And that could that doesn't mean a 20% fall in Chinese GDP, just a shift in where that GDP comes from. So I think so, but I guess we'll see. It's been like that for a long time and they've found ways each time to kick the can down the road. So,
I wonder if that's the scenario that we've all kind of forgotten about because it's been maybe gonna happen for so long but hasn't, is like what does actually happen if massively demand for Australian commodities drops and the price drops, iron goes back down to $60 and coal's been pretty high for a while as well. I think gas is going reasonably well as I understand it. So I guess we could find out what happens in that scenario, but at the same time, it's not something that how do you necessarily prepare for that? You're going to just have to take it as it comes, I guess.
I definitely think there's something to be said there, Claude, with what you said on that's not the perfect analogy, but the boy who cried wolf kind of idea where it's like a lot of people, this is going to end bad, it's going to end bad. And you get a fatigue with that sort of story. It's like, I've heard you, China Bears. Yep. And you have been wrong for close to 10 years now. So I'm just going to stop listening to you, which is, maybe apparently there's two ways of looking at it. There's the one that there's a broken clock is right twice a day. So maybe their moment in the sun is going to come. Or the other is like, no, why are we listening to these doomsayers when it's not happened yet. And as you said, Matt, potentially you could kick this can down the road for many, many, many more years to come.
Yeah,
I
think that the risk of China not wanting our stuff is a much, much lower than the risk of China really wanting our stuff and interfering in our country and politics to ensure that they get supply of our stuff.
But there is, I can see one thing that I don't subscribe to, which is a lot of people will hand wave some issues away by saying it's a command economy. They don't have the normal political reality that we might experience in the West. And if they need to do something, they will just do something. It's like, okay, granted, I get that. But at the same time, I would argue that there are certain economic realities, no matter what school of thought you might subscribe to. Is like you can't just build stuff forever with absolutely no payback. There is a cost to that at some point. Like that money has come from somewhere, and those people providing that money will either want a return, or they're the kind of people that can create money, in which case they'll just be diluting everyone else. Like, do you know what I mean? Like I feel as though if that was the answer years and years, 100 years ago plus, we would have figured out that, we can just always command economy our way to never have recessions and never have consequences for profligacy and etc. Right? Like there's still I'm hesitating to use the word law of economics because it's very much a soft science, but there are somewhat certain, I would imagine, incontrovertible laws that are at play here.
Yeah, I think there's a return on investment thing. If you make enough malinvestment, your returns start going down. It starts affecting the economy.
The real world consequence.
So yeah, I think the short answer is yes. I think you're right. I think that they do have a lot more scope to make changes. The problem with a command economy is that you have less feedback, so it's easier to make the wrong thing or keep doing the wrong thing for a long time. And maybe that's what's happened. So anyway,
and that's the local government issue, I think, too, because they have some really weird incentives at play.
Yeah.
And the debt's just piled up there. But again, it's sort of like bridges to nowhere will have real world impacts. Anyway, I don't know. I'm not trying to be bearish for the sake of it. It was just something that was in the news. I thought, no one's mentioning this. And it's kind of like the Ukraine war or Israel and Gaza, or, it's just sort of like when it first happens, it's all you hear about. It's plastered everywhere. And then we all just get bored. Yeah. And it's like, it's still happening, guys. Yeah, this is still an issue here, right?
Yeah.
Anyway, it's interesting.
All right, let's get into some stock-specific stuff. Nanosonics was one that reported just after we recorded last week. It was smashed down 30%. I think it's recovered a little bit since then. You guys know this one fairly well. So basically, the story was it had been projecting much higher growth of, I think, 15 to 20%. And it came in with revenue actually going slightly backwards and having challenges on new sales. I don't know if either of you guys had a look at it, what your thoughts were on the moves.
Yeah, I had a quick look. It is a company that I like the razor blade business model side of it. I've always been interested in that like recurring revenue side of it, which is the consumable parts, which really has to do with the installed base. Now, what's happening is the installed base has been the growth of the installed base has been slowing for a while as they reach high penetration in the most profitable US market, and it's been very slow to bring on new markets really and make them meaningful with the installed base. And yet, that is the thing that really matters the most. The way I've been following this company for a fair few years and own shares for a while. I sold a while back now, but they really seem to have lost their way in the sense that the reason to own it was just to have that new installed base growth as global as much as possible, so that you build that really high margin consumables revenue, which could one day you could see just gushing cash and being very profitable, high profit margin revenue. And really what's happened is that there's been a number of projects to grow the company. One has been the Trophon 2. Now, this particular half-year result, what's disappointed was the number of Trophon 2 upgrades. So the theory from many years ago was that people would replace them in a certain number of years. And I was always a little bit skeptical of this source of growth and never really factored it in. But the company has had some success with it. And but then this half is disappointed. And I think, perhaps I do think that there's an argument to be made that really the smart thing for a hospital to do to save some money is to delay upgrading their trophon that works perfectly well. Because there's no real reason that I've never understood the reason why a hospital must upgrade to the new one at fairly great expense. So there obviously is some selling points because they do get upgrades, but at the same time, that probably isn't as important for the company as just growing the installed base. And then secondly from that is, look, I looked back at sort of the old announcements, and I think, did I tell you guys, is it in our chat? But I think it was like 2020 or something. Initially, at one point at the final part of 2020 was when they were expecting to sort of launch the new product, which turned out to be Chorus. And of course, it's like years later that happens. And I can stand corrected if I'm wrong on that. I tweeted it. I can check that later and correct myself if necessary. But the point is that this has been much slower than expected, and there's no doubt about that as well. And again, many millions of dollars, tens of millions of dollars spent on developing this new product, which is yet to contribute anything. And probably it would have been better off if, again, all that money and effort had just been spent to expanding that installed base, get as many people as possible using this massive network of things, and then absolutely have this beautiful revenue stream that you can then start valuing, quite highly on probably quite a high PE ratio, because it's almost like yielding free cash flow as a hospital continues to be trapped into using this device. Basically, would be the target. So, didn't really go the way that I initially was thinking when I first looked at this many years ago, and I think that thesis creep sort of gradually happens in a way as you go along with the narrative of the company. And I would definitely be interested in this again if the company just said, hey, we're going to do installed base and we're going to try and harvest free cash flow. Then I'd be really happy and only expend growth into expanding that installed base of products. So let's see what happens. There's some risk that there's going to be an always R&D company, and so we never actually see profits. And that's the one thing, I guess, that is nerve-wracking for investors now, because over the last few years, the track record, the achievements have not been great. And then that has the market second-guessing, the whole direction that the board is choosing and the management and everything. So I think that's where we are at the moment. There could be an opportunity sometime, but right now, I think there may need to be really, it's probably time for a fresh new approach here, because what they've been doing for the last few years hasn't really paid off in ways you'd hope to see.
What do you reckon, Andrew?
I mean, I think it's an incredible business. I mean, the amount it requires a nuanced view, because you have to, not to forgive management or go against any of the points that Claude makes, which I agree with. But if that core business is a phenomenal one, right? And that has been growing very, very well, very consistently. Lots of high margin consumables there, very reliable as well. I think the bigger error here was more the market, really, frankly. This thing was trading at an eye-watering multiple, pretty much on the expectation that this new product was going to be a home run, which it may well still be. It is a big market opportunity. They have form in this general area. So, maybe it's too early to kind of call it. But even now with things pulling back, and even if you want to strip out, like, let's get rid of the added development costs that are associated with this and focus just on the core business, what would that look like? And even look like it under lower growth assumptions. I mean, I think you reminded me, Matt, they've got 50% of the US market already, so they will cap out at some point. It's still I feel as though it's more for me a valuation concern than anything else. The balance sheet is an absolute fortress of a balance sheet in terms of the cash pile that they have there. I mean, what else do you want in a company that's largely acyclical, huge amounts of recurring revenue, nice high margins, oodles of free cash flow, et cetera, et cetera, et cetera? It was just silly. So that's why I sold out too. You'll see it on Strawman. It was nothing to do with the business and its prospects. It was just one of priced for perfection is the term that I think applies very well here. And I feel as though with the pullback, that's probably I don't think it's necessarily cheap unless we see some big acceleration in growth or some massive traction from Chorus. Similar, I don't want to change the topic, but I mean, we saw a similar fall with Domino's, right? And credit where it's due. That's been of all the tech stories and themes over the years, like a pizza company has like knocked it out of the park in so many ways. But again, extraordinarily high valuation on the assumption that that pace of growth could continue. So I probably put the quote unquote fault here in terms of looking at what's happened on the market towards the market itself. It had way too much expectation priced into it. Not even contemplating the macro backdrop of rising interest rates, et cetera, et cetera. So I don't know. What do you think, Matt?
Yeah, I mean, I think you touched on a few things. If you look at it on paper now, it doesn't look very good, right? It's like not growing on paper in the most recent half, not just on paper. It's not, but is that going to be permanent? But look at that, and then it's still on like 5 times sales, and an absurd multiple of earnings because the earnings that fell and are quite low. And I think the question is just, is there, that can put a stock in a really difficult spot, right? Because it's between two stories. And I was just thinking actually about Tesla the other day. Tesla's kind of in a similar thing.
Yes.
If you look at Tesla on paper right now, it looks terrible because it's quote unquote between growth waves. It's, it's not growing. It's got this major competitor, BYD in China, that's now bigger than it and is like aggressively funded by Chinese government and is kind of winning, pushing down cheaper vehicles. And it's on an absurdly high valuation. But it's still got the faith, I think, even although it's, share prices come off, it's still got the faith of, Musk and the story there. And I don't know if Nanosonics, that's probably the question for the share price is just, are people going to keep the faith after they've been waiting this long for something to deliver? So I guess that's the danger of owning it at this stage is like, which side is going to win out? Because I think, as you said, Andrew, it could fall significantly further if people start thinking, I'm going to price this on earnings, and I'm not going to take away some of that blue sky and think, it'll probably be a long time. And then suddenly you're not on big multiples of sales anymore. You're on earnings, and everything comes back down.
It's that Silicon Valley skit, right? It's like, no, we don't want earnings.
Right?
As soon as we have earnings, our multiples are going to look really bad.
Oh, that's even revenue. That's good. It's like
revenue. Yeah, that's right. That's right. Exactly.
So that's my take on it. I actually, as funny, I went back and tracked down that we talked about in 2019 because it stuck in my mind that at the time it was 15 times sales, and I said I would own it when it's like 5 times sales, and you guys are like, whatever, you're crazy. But now that it is 5 times sales now. But it's not that appealing, right? Because it's 5 times sales because growth has stopped. I meant 5 times sales when it's growing 30% a year. So yeah, it's funny how those things can happen.
Speaking of that, I reckon still that the multiple that's interesting is I think 5 times sales, even with not that much growth, if it's 5 times the consumable sales, that I think does make sense. 5 or 6 times the consumable sales. And if you just ignore the rest of the business completely, which is definitely where I would find comfort in the valuation, because I think I would pay 5 to 6 times sales for just the consumables, even if the growth wasn't that good on the trailing 12 months, because I would know that it would have ups and downs, but generally that consumables revenue would go up. So the consumables, if that's going up, even if the overall revenue is going down because the actual new capital sales went down, but the consumables are still going up. What I would do is I would say, well, I'll look at the consumables on 5 to 6 times revenue and see that is still growing and probably is going to keep growing, albeit at a declining rate. And then if the whole company is being looked at as its X growth because its revenue's down or whatever, or flat completely, but actually the part that I care about is still growing, that's where I would kind of see the opportunity. So, after looking at it and talking about it, with you guys, but also just after seeing this results and seeing the disappointment, I have put it back on my watch list just because it's still not 5 or 6 times consumable sales. I think they're about 110 million in FY 2023. And so that would be, we're talking about 660 million or something is the market cap that would be 5 or 6 times. But that's kind of just what I'd sketched out in my mind. Obviously, we're not there yet, so I'm not thinking about it too heavily. But if that happened, I think that it would be time to really sharpen the pencil and get out the old DCF and try and put in a few numbers.
That'd be my point too. This is not a business that's in any way terminal. I'd very much hasten to add. We're talking about we can debate the rate of growth, but I feel as though the rumor of their demise is greatly exaggerated. Not that necessarily a lot of people are saying that. It is actually very reminiscent of. I'm just looking at their latest full year preso, right? So FY19, FY20, they went from 84 to 100 million in revenue. Again, big multiple, big growth opportunity, et cetera, et cetera. And then FY21, they did 103 million. In fact, first half FY20 to first half FY21, we actually saw revenue drop from 48 to 43 million. And coincidentally, we saw at the start of 2021, the share price was at $7. In fact, it was at $8 in late December of 2020. And then it dropped 30% by the end of that calendar year as that growth narrative got wiped away back to $5, which, by the way, is not far off double what the current price is. But the point I wanted to make is though that was 103 million in total revenue in FY21 and FY23, the most recent full year, we had 166 million. So we've had 65% odd growth in revenue at the top line in that 2-year period following that. So the open question is, and I'm keen to see what other people think, is this one of those sort of natural variations in business? We had a pretty crappy half and not a great full year, but otherwise things are great. Will we be looking at a disappointing FY24 only in FY26, FY27 to be going, oh no, growth started to accelerate again? That'd be the question to answer, I guess.
I reckon it might be, or might not be, but either way, I think we're getting to the point where the share price is sufficiently low now that I reckon that the risk reward is more in your favor, basically, because I do actually think that there's a decent chance that it won't be as bad as what the market is thinking right now. And I think that all of what I talked about, the multiple disappointments and the expectations were this, and then people losing confidence in the decision making and stuff like that. So I'm saying I think sentiment's already low and could be lower. What you might see sociologically is a lot of people saying, it's a bit of a stale board and a stale management and a stale strategy. What we'd like to see is a bit more of a focus on free cash flow or profit. And if that causes a bit of a change and more of a refreshing attitude at the company, you could see sometimes that kind of moment when they say, all right, we're going to go in this new direction now. That can be a good sign. That could be a good sign then where it's like, so the prevailing sentiment is regarding, this, I guess, dashed hopes of growth, but then it got cheap enough that the company was convinced to just focus on gushing some cash. And then that can create a new narrative. And then I guess you're not between stories, because now you can start having the, we're going to start dropping off how much we spent on R&D, and we're going to start seeing free cash flow flood down and a bit of operating leverage and that kind of thing. That could be a different new narrative that could drive it higher. I just, you have to figure out what price you think that it'll go to, but people could extrapolate growth in free cash flow too high as well. So see what happens. Like, we do have a couple of good businesses on the ASX that have managed to continue to grow these kind of medical device models in Cochlear and ResMed. So it's not that crazy that something could something better than what we have today in Nanosonics could eventuate in the future.
Yeah, great point, man. All right, let's go on to a couple of questions we had through. One from Nick. Hi, guys. Love your podcast. Gives new meaning to the term, thank God it's Friday, when I see the new apps. Very nice. I'd love your thoughts on RFG, which is Retail Food Group. Yahoo Finance has a market cap of 137 million. They've done recent acquisition. He gives some other stats. They've done recent acquisition. ACCC issues are in the past, and they're still standing. New CEO seems decent, and just going by my LinkedIn BS detector, he seems good. If I love coffee and donuts, so should everyone else, which is always a good basis for a thought. What am I missing? Thanks, guys. Have a great Christmas break, and hope to hear you again in 24. Cheers, Nick. What do you guys think of Retail Food Group?
Well, I mentioned Godfrey's before, and how I questioned. Oh, no. Well, I questioned, was that a value trap or a buying opportunity? And I was suckered in when there was wobbles years ago on that, thinking, I guess there's some trouble, but look how cheap it is. and finally bit the bullet. Took a horrendous loss, but that loss was. I mean, that loss was taken at a price that was well above the current one. So it's actually
Where did you sell, Andrew? Do you remember? Do you remember the numbers or no?
It actually so happens I have
it's your screen
share site open.
Oh, okay.
I'll have to quickly look it up, but I don't know. It, like well above.
Yeah, I think from memory it might have been a bit over $1 or something. But either way, like at the time, it felt like I just remember it was kind of last week we were talking about Apple and how it was a stock that fell 80%, then 50%, and then 90%. Like, and just how much you can trim losses by just being willing to sell when you realize your thesis is broken, even if it feels like it's already fallen a long way. And I think it had fallen a decent way when you sold, but it might be down 90 or 95% since then. So it's pretty wild.
Yeah, it was the right move to sell. I feel. It was a real bad stock to get people into that. I feel also like, obviously everyone, like the team generally liked it at Motley Fool for a while there. And it was good to go against it and to sell, mate. And that was a good call. But also it really reminded me like just how bad the franchising model can be. Because the thing that you don't see, like when the results looked good, because once upon a time, the results of it looked really good. Like it was growing dividends and growing profits and et cetera, et cetera. But, the situation was unsustainable for the franchisees. Like they were getting squeezed too hard and there wasn't enough profit in for them. And
that was the lesson. Yep.
Yeah. And so like that's this off balance sheet thing that you can't see, which is that there's, it's not sustainable. You cannot keep doing this. People are reaching breaking point. And also the growth model ultimately relies on you finding more people to become franchisees. They're not going to want to do that if they're looking about about what happened to the other franchisees who have got dashed dreams and broken hearts. Like, so that's the thing that you can't it's really hard to understand, I guess. That kind of business, what it was. And then of course, once it gets so low and it was indebted and actually wasn't in good health, and so the actual trading equity becomes very leveraged. I'm not sure what the leverage is right now.
Yeah. I mean, that's part of the success of McDonald's, right? Is they look after their franchisees. Like it's a win-win relationship. And in this, the power dynamic shifted too much in favor of the corporate entity, and everyone was just so squeezed. I mean, there used to be a time, I'm old enough to remember, where you could go to Michelle's or whatever and get a decent coffee and some nice fresh baked goods. And now it's just all, it's very low quality. I don't know if I've ever walked past one in recent years at a Westfield or wherever. It just hasn't been dead and depressing and some poor bugger behind the counter with just, no soul back there because they've been squeezed within an inch of their life. And it's that idea of when they went really bad, it was this idea of cut yourself to greatness, which is the exact opposite. You kind of need to sort of double down on what made the sort of consumer experience special on that. And by offering even cheaper, crappier products was not the way to climb out of that hole.
There's a great article by Smart Company on Smart Company website with the headline, Michelle's patisserie franchisees seek millions in lawsuit over quotation marks disgusting foods. And it has a bunch of pictures of some of the cakes that they received. So obviously it's very heartbreaking for them. They're trying to run a nice little business. They thought someone's going to take care of bringing me all the cakes and yada yada, and then they're suing them.
What year was that quote? Was that a recent one?
That was published in 2021.
Okay, let's just flip it because we know that it was a basket case. I just checked; it's down. It is now 99% at least below its high.
I sold it at $1.62 is when I got out.
$1.62, yeah. So
it's still a rebound story.
It's wild.
Could be.
So it might have been down 70% when you sold it, Andrew, and then it fell another 90. What? More than that?
Yep.
Yeah. Anyway. It's pretty wild. 95. Anyway.
I love how I'm patting myself on the back for such an eye-watering loss.
Well, I've got out the annual report for FY 2023. They did only a EBITDA of 3.5 million in FY 2023, and the actual loss was 9.2 million retail food group there. So it's definitely not like
what I was going to
buoyant.
ask, what would you want to see for you to be interested in it again? Obviously, the original thesis is these businesses can be quite attractive. A master franchisor has a lot of great economics. Starbucks is a master franchisor. There's lots of great franchise businesses.
Yeah.
What would you want to see to be, maybe to reframe it?
I'd want to see a return to growth at least at the top line, right? Mm-hmm. But so there was obviously a big reset when everything hit the fan. But then,
so they've got they seem to have growth now. Just looking at FY23, it's same store sales growth at 12%, network sales growth 7%.
It's the first uptick on an annual basis, though, since the reset. So, and it's yes, I probably would want to see further evidence of that.
I would want to see profit and free cash flow. Basically, like a nice, clean profit result that's like matched up with cash flow, and it's actual, and then that cash flow can be used to reduce the debt. That's what I'd want to see. And then if you could just sort of then start doing maths where you're like, well, if they do this for X many years just without even growing much, then they'll have no debt, and then it'll still be if it was doing profit and free cash flow, and then I could make an easy case where like they don't actually have to grow and they just have to keep doing what they're doing and they'll pay off. That's probably the scenario which I could imagine myself kind of being interested. But again, that would be more for just like private trader Claude. Like I definitely don't want to take people on a journey of like terrible retail, like from the ashes will they rise kind of turnaround stories. Like it's definitely doesn't sound fun to me. It sounds pretty harrowing.
Yeah. I'm also just a bit negative, and this is hard as an investor not to overlay your personal preferences when dealing with any kind of B2C kind of business. You might look at it and go, I would never eat at Crust Pizza. And that's not really the point. The point is we'll do others, you know? So that qualifier out of the way, I think Brumbies is a special banner. I think they've got their good reputation. But when I look at things like Gloria Jeans, Michelle's, Crust, Pizza Capers, they're not, at least to my mind, will not go out of my way to go there. And in fact, will go out of my way to not go there. And so, keeping my initial comment in mind.
Last choice.
When we had a crust near us at our old house, and it was very expensive, very average. And then there was a local pizza place around the corner, a little bit more expensive, but just incredible pizza. And it was like, the locals sort of knew it. Coffee, Gloria Jeans, and these kinds of places in Australia where there's a mad cafe culture.
So
there's really high standard. I don't know.
My first ever job was at Gloria Jeans on Oxford Street. I had the 6 a.m. Sunday shift.
Yeah.
How did you back in the day when Sydney, Oxford, this was like before all the lockdowns.
I just can't imagine you getting up at 6 a.m.
That's on Sunday.
Especially like younger Claude. I think today Claude would struggle with that.
He just pushed straight through.
I know, it's amazing. I did it though. There was actually
I bet you called in sick every second weekend. I bet you were a nightmare for your shift manager. Yeah.
I didn't. What are you talking about? I was great. I didn't last that long, but I did it. That's how I learned how to make a coffee. No, what?
That's good. I used to be a call center manager on the weekends, and man, I had a few phone calls from quote unquote sick people. All right, well, guys, let's jump to another one. Hi guys, interested in a discussion on portfolio construction when investing in small microcaps, specifically if you work full-time and only have, say, 5 hours to research monitor your portfolio. Should you put an upper limit on the number of holdings or have a small number of positions to be diversified against the risk / lack of research? With the caveat, none of this is investment advice. What's your personal approach, guys? How do you guys think about if you're in a similar position where you weren't doing this full-time, how would you think about how many positions to have to kind of monitor for a small microcap investing?
Okay, I'll go first. I think diversification is oversold, which is a bold statement. I know. I think obviously it's important, right? Like I want to be very clear on that. But I think a lot of our listeners will be very familiar with the chart, which sort of shows how risk drops relative to the number of positions in a portfolio, assuming non-correlation. You get the maximum benefits at 15. In fact, you get something like 80% of the full benefit that you'll ever get at 10. So I've always found that I would rather Do you want, as an investor, particularly a time poor investor, do you want to be an inch deep and a mile wide? Or would you just rather, was it Charlie Munger who said, like, that's not better to have you can have all your eggs in a small basket or one basket, just watch that basket like a hawk. God, I butchered that. But, something like
your
that.
eggs in a small basket.
You can have a basket.
You can have 10 small baskets. You can
Just don't forget where you hide the small basket.
Oh man. So I tend to think, and why I say diversification is oversold is that even if you had 10 stocks and one goes to zero, all else being equal, it's a 10% loss. And the thing that I think gets overlooked with all of that is that whatever protections diversification gives you on the downside, it quote unquote protects you from the upside as well. So if you have 20 stocks and one like 5X's, all weightings being equal, like the overall impact to your portfolio isn't as great as you might think. So I prefer to have small and concentrated. I'll probably there's a difference between, like, I know, Claude, you're big on having watching positions. So you've got sort of your core portfolio, which might make up 90%
these days.
of the
I
capital.
don't at the moment, by the way. But yes, I intend to go back to my old ways as soon as I don't have to write so much.
So I mentioned that because you might technically have 30 or 40 stocks in your portfolio, but if 10 of those make up,
I'm going to go back to that one day.
But if 10 stocks make up 90%, I think that's the point. And I would, personally, I prefer to go that way. You'll find that life is a lot easier. I tend to think. Let's work.
Yeah.
Cool. All right. Claude agrees.
That was an uncomfortable silence. Like, okay, crazy guy.
And now he's trying to decide what else to talk about.
I wanted to go through a few.
He's even doing it to me now as I describe how he's not listening. He's like,
I am listening. What are you talking about? I'm agreeing with you.
All right. I think we're all pretty similar on that. I'll just say Charlie Munger's thing is diversifications when you don't know what you're doing. I just say when you're starting out, you don't know what you're doing. So don't. I would caution people generally against owning like a couple of stocks thinking they're Warren Buffett when you're not Warren Buffett. Well, probably never will be, but also just to starting out, you need to be prepared. Spreading a bit wider can help you not take such punishing L's.
Yes, I'll double down on that. And just very quickly, but you can kind of have the experience of it. So you might put 80% into a ETF, for example, and then have 20% in 10 stocks. That way, you're never going to get yourself in too much trouble, but you get to sort of have the interest and excitement of a more concentrated direct portfolio.
Yeah, Claude, sorry, what were you going to say?
No, I wanted to ask your opinion on this company, Keypath Education, which put out a quarterly recently. And I wrote a short article about it on the website. There wasn't really much there. Basically, according to the AFR, universities provide the course content and deliver the courses. Online program managers such as Keypath design the course and market the program while also dealing with recruitment, support, and the retention of students. And so this is a IPO that seemed to be like massively overhyped. I think it reached very briefly $4. It's now about 40 cents. So it's gone about 90% down. And the only reason that I bring it up is because their most recent quarterly was strongly cash flow positive. Now, of course, the lumpiness of cash flow means that it will quite likely go, I guess, negative at some point in the future this year. And I'm not saying it's profitable yet, but it does lead credence to the idea that they are on a path to cash flow break even. So I just wanted to, see if you guys had ever heard of basically this kind of business and what you sort of think of that business model.
I had looked at it at IPO and thought it was crazy expensive. And I haven't probably tracked it as much as it's fallen. So I probably need to take another look at it. At the time it wasn't really growing much. I guess it looks like it isn't still growing much, but it's probably managed its costs a lot better. So I had a read through the article that you put on A Rich Life. And I think it was why it looks interesting. Didn't even have a question mark in your title, which I thought was very bold. But no, I agree. I think it does look interesting. I guess it's just what it's interesting for. It's kind of like that. Can you generate enough cash to justify the market cap, and then maybe you get some growth from there? Yeah, I
Yeah,
didn't have
it's
anything
mostly
super
just, it
negative
looks
on the
interesting
business
because I
I
just see
looked
it's down so much, like 90%, but it's not just a pure story stock. Like it has, over 100 million US revenue. Like, I'm like, sure, is this revenue that can be profitable, or is it just pie in the sky stuff, I guess is the question. So very, very interested to hear from any readers who have an understanding of this business model. It's the kind of thing that I'm like, wow, I don't understand, what's going on. It's like they're getting paid money to go out and recruit people to like go these courses. Like it's a very for-profit model that it's hard to understand, I guess. But and to just, is it sustainable? Are there any pitfalls to that? I don't really know the answer to those questions. But yeah, it's a real business. It's down 90%. So I guess I'm vaguely interested. Maybe now you made me think that it was too positive. I was like, I'm not saying it's a good stock. I'm just saying it's interesting.
It's all a matter of framing and perspective, right? So you kind of say, what a disastrous float. I'll make the point, I've made it before. It's just like in a horribly amoral Machiavellian way, the brokers that brought that to market deserve a massive pat on the back that they were able to sell that at those multiples, right? Like,
someone's like, stocks are down 90%. Andrew's like, but on the bright side,
the brokers.
How good for the seller?
Just remember, the lesson here is with IPOs, remember that they are looking to, more often than not, they are looking to exit. They're obviously looking to get the very best price, and it is going to be dressed up like, all get out to make it look as attractive as possible. So there's, I generally am pretty happy to stay away from IPOs. I figure if it turns out to be the brilliant company that the prospectus makes it out to be, it's like I'd rather be late and leave a little bit of money on the lose out on some early upside, but invest with much more conviction once it sort of had the bright light of public market scrutiny on it for a little while.
Yeah, makes sense. Claude, you wanted us to have a segment on gratitude, and you weren't here last week, so I thought I should give you an opportunity to share about something you're grateful for. Close out the pod.
All right. Well, obviously, I'm super grateful for my friends and family. That's my number one. I know that was yours too, something like that, or yours it was your family, Matt. But yeah, that's a number one thing, obviously close to my heart. But I thought I'd also choose like little random things because that's part of how to practice gratitude. Really, is it's maybe having an appreciation for little things that you wouldn't otherwise notice. So I appreciate I think it's called a crepe myrtle tree that I can see from my desk, which is
nice.
in bright pink bloom at the moment. That's a nice little thing about this time of year for me. So that's my one.
Andrew, you got anything? You were pretty doomer last week. You were struggling to enjoy anything in your life, I think. But
I'm going to be, I don't want to count chickens, but I am going to be very grateful for never having to deal with a bloody RE agent again.
You can't be a negative thing. I knew you would do that.
I want to say, like, I personally have encountered wonderful real estate agents.
Really?
Maybe it's, who's the common denominator in every bad real estate agent interaction?
Do you know what I was thinking? I was thinking about Andrew's bias against real estate views. And do you know why? It's because he only ever deals with real estate agents, like not only ever, but has mostly dealt with real estate agents through being like the rental manager and him, which I have to say, I agree. I've had poor experiences with both as a landlord and a tenant.
It's a different experience as a buyer. I'll definitely say that, but it's still not a great one.
No, and a seller. I've had the same real estate agent sell me a house and then sell that same house, and I enjoyed doing business with her both times. And I feel like there's been real estate agents that I've really liked. So
psychopaths are really good
nice ones,
and making them. They tend to be pretty charming. So.
Very good.
Okay,
right.
Fair enough.
Should we wrap it there?
No, okay.
You tell us something you're grateful for, Matt, at least.
I'm grateful for so many things, man. I'm grateful for everything. I'm grateful for 4C season at the moment. I'm grateful I've got several hundred things to go through, even though
lots of rocks to look at. Lots of rocks to look under.
Exactly.
Yeah. Okay.
All right. Let's wrap it there. Hit us up on Twitter at BabyGiantsPod. We'll think of Andrew. Will have to think of something actually positive for his gratitude next week, not another rant. And thanks very much for listening.
All right. See you, everyone. Have a great day.